Hi, this is Eric Higgins, Waaden Chair of Investment Management and Center for Principal Business Faculty Fellow in the College of Business at Kansas State University. I often get asked, what's going to happen in the stock market? Is the stock market too high? Is the stock market too low? And especially when we think about, the situation today, we've got this global pandemic happening. Today, and I'll talk a little bit about it, we saw that GDP dropped 32.9% in the second quarter. But yet, if we look at the markets, they're almost back, and in some cases, like the NASDAQ, above where they were before the start of the pandemic. So, I get these questions, what's going on? My answer usually is, I don't know, and I'm not sure that it really matters. And so, that usually is not a very satisfying explanation for people. So I want to try to break that down a little bit today for you in a short presentation called Expectations, Reality, and Mr. Market. And so when we start talking about the market, I think it's important for us to define what is the market. We kind of, a lot of times, think of the market as this nebulous creature that just determines our long run wealth, but it's not. It's a conglomeration of individual stocks. It's, we look at an index like the S&P 500 or the NASDAQ Composite or the Dow Jones. Those are all companies. Those are all individual companies. They're stocks. And what's a stock? A stock is an ownership in a business. So the market, we think about the stock market, it's this conglomeration of these businesses that people have some sort of ownership in. If you own an index like the S&P 500, you own a small piece of all 500 of those businesses. Or if you buy individual stocks, you own a small piece of that individual business. So I think it's important to remember what the market is. It's these businesses. It's our economy in a lot of ways. What we produce, the things that we do. And so then if we have that kind of as a background, then what moves the market? It's going to be the things that impact these businesses. So individual business performance, are they doing well? Are they doing poorly? Aggregate performance, you'll see it in different sectors. Like right now, restaurants, retail, airlines, cruise lines, not doing well. Tech companies, biotech, those developing vaccines and treatments for COVID-19 are doing very well. So you get these aggregate performances. Economic news like today, the announcement of GDP, non-economic news, so pandemics, wars, whatever it may be that might impact businesses. So basically, what's going to move the market is anything that impacts business performance. But sometimes we have to separate a little bit between expectations and reality. The things that I mentioned previously are all realities. Businesses perform well or they perform poorly. Economic news is good or bad. Non-economic news is good or bad. Those are all realities. How the market responds to those realities is based on what the market expects. Generally speaking, we think that markets are forward-looking. So as information comes into the market, the market updates their expectations for these businesses, and then the price moves in the aggregate. And so that's typically what we see. But oftentimes, expectations and reality don't always line up. And to understand that, we have to understand that market participants are not some sort of robotic sort of machines. They're not computers. They're individuals who respond to this information and then trade and make decisions on what they think is appropriate. And those individuals, all of us individuals, are impacted by fear and greed, basically uncertainty. When there's uncertainty in a market, we're going to respond kind of wildly. We'll either be really happy or really sad or want to take some profit or look for opportunities, whatever it is. Individuals are the people that drive the market. And so we take a look at today, for example. Today's July 30th. GDP was announced today, as I mentioned, and it dropped 32.9%. That's reality. It already happened, but we weren't sure what it was going to be until we get the numbers. Most economists predicted a 34% drop in aggregate on average for GDP. So that's the expectation. So the reality was actually a little bit better than the expectation. But the market's gone down. It's down about 0.5% as of this writing and this presentation. It was actually lower in the day. It's kind of coming back. Again, I understand there's other economic news that came out. There was some information on unemployment that wasn't great, but there's this news that comes out. However, when we think about this, my point here is that the market response, this expectation, is not necessarily tied to a reality. It's a voting machine. And this comes from Benjamin Graham, and I'll put up his book, and hopefully it focuses well. But I'm going to quote from this book later. The Intelligent Investor. To me, this is a must read. If you haven't read it, read it. If you've read it again. It's always good to read it during times of market crisis because it gives you a lot of good wisdom to think about when you're looking at markets. Also, Warren Buffett writes his letters to shareholders, and in fact, Warren Buffett references in his 1987 letter to shareholders this book and talks a little bit about this. But the idea is that in markets, each day the market, and again, the market is individuals. They respond to news and events and offer up some sort of vote as to how they believe that impacts business value. I think the best way of thinking about it is the example that Benjamin Graham and Warren Buffett use, and that's the analogy of this person called Mr. Market. So the way to think about this is assume that you own a business and your partner is Mr. Market. You own 50% of this business and Mr. Market owns 50%. Each day Mr. Market comes to you with a price for your share of that business. And each day Mr. Market's price is influenced by news and events that Mr. Market observes, GDP, virus news, whatever it is. Some days Mr. Market is extremely worried and thinks the value of the business has dropped and offers you some ridiculously low price. Some days Mr. Market is extremely happy and offers you a ridiculously high price. The point of Mr. Market, and when we think of Mr. Market, we're talking broadly about the stock market, is that you have the choice. You have the choice to take that price or not. And each day, Mr. Market's going to keep coming back and coming back and coming back and offering you a different price. And so you have to assess whether or not you think Mr. Market's price is ridiculously high and maybe you should sell, or ridiculously low and you wouldn't want to sell. Maybe you'd want to try to buy some of Mr. Market's shares, whatever it is. And so really that's the way the market is. It's responding, it's voting based on this information and offering you this price. So what does that mean then? What's the true value of the market? And honestly, the true value of the market are the value of the underlying businesses that compose that market. So we think about a lot of times in finances, it's the discounted cash flow of all future values and, all this, all that sort of financy stuff. In the long run, it's kind of, like a weighing machine. And that's another example that Benjamin Graham and Warren Buffett use. So, some businesses, long-term have better prospects and they're maybe worth a little bit more, some are less. Over the long run, their value and the value of the market is going to be based on the value of those businesses. Some days, some years, some cycles, things may look cheap, things may look expensive. It depends on the day. So I want to give you a little example about this, and this is just the S&P 500 and the NASDAQ Composite. I'll start there. Really around the start of the pandemic. So the market kind of peaked in February, mid-February of 2020. You can see the S&P 500 was at 3386 and the NASDAQ was at 9817. The kind of bottom of the market occurred in late March. So the S&P had fallen about 34%. The NASDAQ had fallen a little bit less than that. But if we look today, the S&P 500 has recovered almost all of its value. Why? We look at it. GDP is awful. Unemployment is awful. All these things are awful. The virus is still out there. again, the market is responding to what they see. They see that the economy is opening up. The expectations for third quarter GDP are that we're going to see really phenomenal growth, 13%. Who knows? We don't know. But obviously, the market is voting today that things are going to get better. When we look at the NASDAQ is well above where it was. Why is that? Well, in the NASDAQ, you have a lot of these biotech companies that are developing the therapeutics and the vaccines to combat the virus. And so there's a big expectation that, wow, one of these is going to take off and it's going to be the greatest thing ever. Also, you get in there that, the idea of like an Amazon, we're moving online. And so we're really seeing the tech thing explode now. And, so it moves up. And again, that's the vote today. We don't know, if it's true or not. The thing that's hard to understand when we get into this kind of voting sort of thing is that, timing, in my opinion, timing the market, and researchers showed this too, timing the market is next to impossible. If somebody were to say to you, you know what, here's my prediction for the market. There's going to be this pandemic virus. The market's going to peak on February 19th. It's going to crater on the 23rd, and it's going to come back by the end of July. Look, nobody would have made that prediction. Anybody that tells you that is probably disingenuous. There's no way that you would have known when the bottom was, when this thing was going to happen, who knows, and the ultimate outcome. Again, the market's going to move, and it's going to vote every day on what they think is going to happen. I want to take a couple of specific examples of companies so you can kind of talk a little bit about, what do we look for then if the market's voting every day? So I'll give you the example of Royal Caribbean, a stock that I follow. Royal Caribbean, obviously cruise line. Actually, before the crisis hit, they actually were up at 134. They were performing phenomenally, had a record year in 2019. Obviously, the pandemic hits. They've got to shut down operations, and their price craters. In fact, it cratered at about 24. Today, it's at 51. It's come back somewhat. I mean, this is an interesting question, right? Clearly, you had this incredibly well-run, valuable company is doing great things, and their business gets completely shut off. And it looks like it's going to be shut off. Obviously, it was second quarter, maybe third quarter, maybe fourth quarter. It's hard to say. So that's going to have a tremendous impact on value. Does it make the company worthless? Well, probably not, right? Eventually people are going to take cruises again. But I think a big thing when you're looking at a company like Royal Caribbean is can they survive? We know they're not going to have any revenues for the foreseeable future. Do they have enough liquidity, enough borrowing capacity, so forth, to keep their fleet intact, to keep their employees intact, so that when things turn around and they're able to do cruises again, they can do that. And that's where you've got to try to assess that. So what's that impact on value? So it was 111 before. Is it worth half that? Is it worth a quarter of that? Is it worth 2/3 of that? That's that individual company assessment that you're trying to make. Another one here is Moderna. Obviously, you've probably heard about Moderna. They are developing a vaccine and are in late stage trials. If you look at them prior to the crisis, they were at 18. They actually started going up as the pandemic expanded, and now they're at 79. Are they worth $79? Well, it depends, right? It depends on whether they're successful ultimately developing the vaccine, how many they sell, what they sell for, all of that. I can tell you Moderna is a company that for the last 4 years hasn't made a dime. They've had negative earnings. Now it's looking pretty positive for them. Clearly when you look at a price of 79 on a company that hasn't made any money previously, you probably go, wow, that seems pretty high, and it probably is. It may be worth that, but if you buy it today, you're not getting any value. If you were, had enough foresight, or you were lucky enough to hold it pre-crisis, you've done pretty well, right? And so, the market is offering you this price based on, this expectation that they may be the one to come up with the vaccine, and then they're going to make a fortune. Even if they make a fortune, the thing may be worth $60. That's what you have to assess as the investor, and look at that price that Mr. Market's giving you and decide, maybe I should sell now. Or maybe the thing's worth $300 and I should buy today. That's your decision that you have to make, and you make that on a daily basis. Now, I would suggest we should be long run investors, right? And that, again, goes back to Benjamin Graham. We should think about it in the long run. And so this comes from Benjamin Graham, and I want to read the quote to you because I think it's really good. Basically, price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply and sell wisely when they advance a great deal. At other times, he will do better if he forgets about the stock market and pays attention to the dividend returns and the operating results of his companies. Really focus on that operating results. What is the company doing? And, when you think about it in a long-term sense, this is true, obviously, if you're investing in individual stocks like Moderna or Royal Caribbean, you've got to make that decision. But even if you're, just simply passively holding the S&P 500 or NASDAQ or whatever it is, you've got to have that long-term view on it. And, when you think about it long-term, whether it's going to be Moderna, whether it's Royal Caribbean comes back or not, we're going to see innovation. We're going to see companies creating value, whether they're existing companies like Moderna and they come up with a vaccine, or they're brand new companies. Or, given this crisis and everybody's online and watching these videos and all that sort of stuff, maybe there's a new company that's going to come up and innovate and create value. Either way, that market is going to go up over time. And if we kind of just don't worry about those fluctuations day to day, quarter to quarter, and recognize that, in the country we're in and in the economy we're in, where you have the opportunity to create businesses and grow wealth and create value, the market's going to continue to go up over a long period of time, and it's going to outperform bonds and savings accounts and everything else. So, keep that in mind. Read The Intelligent Investor, a great book. And I hope that everybody out there is doing well and is staying safe. Thank you for listening, and we appreciate you. Thank you.